The machine of banking, from economic growth to societal burden. Banking, at its core, operates as a sophisticated mechanism designed to achieve economies of scale, pooling resources, and increasing capital efficiency. Like a well-oiled machine, banking is meant to leverage the collective assets of society, allowing it to extend credit, fund investments, and drive growth with a level of efficiency that amplifies productivity across the economy. By facilitating economic activity on a large scale, banks can, in theory, lower transaction costs, create more opportunities, and foster sustainable growth. The engine of economic efficiency, fractional reserve banking. Central to banking's functionality is fractional reserve banking. By leveraging customer deposits to extend credit and invest in productive ventures, banks can magnify economic activity beyond what individual depositors could achieve alone. As long as the majority of customers don't withdraw their deposits simultaneously, banks can generate returns on investments that benefit the broader economy. This mechanism depends on a delicate balance. When reserves are over-leveraged, the economy risks inflationary pressure, an imbalance where excess currency chases a limited supply of goods and services, driving up prices without corresponding increases in productivity. The equation, MV equals PQ, succinctly captures this balance. When the money supply, M, grows faster than the output of goods and services, Q, inflation, P, tends to rise. With responsible leverage, banks can increase the money supply in line with economic output, creating a foundation for sustainable growth. However, excessive leverage disrupts this balance, compromising the very efficiency banks aim to achieve. The parallel structure of insurance, risk pooling. Banking's principles find a close cousin in insurance, where pooled premiums provide coverage for individuals, allowing payouts in case of claims without risking the insurer's solvency. As with banking, insurance relies on the likelihood that not all policyholders will make claims simultaneously. This risk pooling enables insurers to operate at scale, managing risks efficiently and creating a safety net for society. The same principles apply in banking. As long as depositors don't all withdraw their funds at once, banks can maintain liquidity and support economic expansion. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. The shift from gold to fiat, unleashing unlimited spending. The transition from the gold standard to a fiat system fundamentally changed the dynamics of banking. Under the gold standard, currency was pegged to gold reserves, limiting the money supply to align with tangible resources. Governments had to justify major expenditures to the public, often through war bonds or public financing, especially for ventures like military campaigns. This system acted as a natural brake on inflation, with the expansion of money supply aligning with real productivity gains. When the gold standard was abandoned, governments gained the ability to print money without these restrictions. This shift made it easier to finance activities without direct public approval, from wars to social programs, leading to an era where unchecked spending became the norm. As a result, resources that might otherwise have funded public infrastructure, education, and health services were diverted toward non-productive or even destructive ventures, with inflationary pressures mounting as a consequence. The consequences of overuse, from benefit to burden. The modern debt load in countries like the United States illustrates how unchecked borrowing and spending have turned the banking mechanism into a societal burden. At over $35 trillion, U.S. national debt now consumes approximately $1 trillion in annual debt servicing, a portion of tax revenue that could otherwise support critical public investments. With debt spirals demanding more resources to maintain, banking no longer serves solely as a machine for economic growth. Instead, it has become a weight, pulling resources away from the very society it was meant to support. This shift compromises the banking system's potential to foster positive multiplier effects. The ripple benefits that come from investing in infrastructure, education, and services that uplift citizens and strengthen the economy over time. When resources are funneled into debt service and non-productive expenditures, society loses the long-term advantages these investments provide, creating a cycle where more effort is required to sustain the system than to advance it. Conclusion: restoring balance to the machine of banking. Banking was conceived as a mechanism for economic efficiency, enabling societies to achieve prosperity through the strategic pooling of resources. However, when leveraged irresponsibly, it becomes a societal burden, diverting resources away from growth enhancing investments and into debt driven spending. To restore banking to its original purpose as a machine that amplifies productivity, societies must reassess the priorities and limits of this powerful mechanism. By aligning spending with productive outcomes, we can ensure that the machine of banking remains a tool for economic growth rather than a weight on society's potential.